Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. The core of the bullish support here for the market during summer and going into November had been the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1809. I've highlighted the whole pitchfork in dark blue so you can visualize the tines more clearly. This move up from the lower tine caused a very prominent series of rises and falls, initially capped by the middle tine, currently at 2038, and supported by the significant February 2021 high at 1894. However, in mid-December last year, prices pushed up through the capping middle tine by a significant margin, but could not maintain a rise, despite making and reaching a target for the November to December 2022 bullish halfway hesitation. We had prices drop back down again as we entered the new year, punching down through the middle tine and all the way down to the February 2021 high again, though this time we also had close by the combination of the rising medium moving average, currently 1918, and the barely rising long moving average, currently 1893. These together, coincidentally, were just happening to be making a golden cross at the same time, and that was at the start of January, causing prices to revert back upwards to the supposed comfort of the congestion at the 1964 area. So last week that left us with an interesting situation. I described it thus, and I quote, "It can be perceived that this subsequent rally could be the beginnings of the formation of a second shoulder in a November 2022 to date possible head and shoulders top. It is way too early to call it that, but the opportunity to create such a pattern is indeed there, especially with possible pipe top made at the start of last week. That is now 2 weeks ago. Alternatively, it could be something else completely, such as another bullish halfway hesitation. In either case, we would need some more price action development to take place to ascertain what is the next pattern." End of quote. That is what I spoke about last week, and what a change we have seen in this past week. Instead of forming the second shoulder of a potential head and shoulders top this week, prices last Tuesday shot higher with an unusual daily key reversal up and have not stopped going higher since. Up through the middle tine and even through that December's high, the highest high since February 2017. Needless to say, the idea of a head and shoulders top is now dead and retired, and a bullish halfway hesitation, well, that was achieved last week. You can see it in the rear view mirror if you look. I'm now trying to gauge what is currently going on and what may be next. The obvious one is that we are set up for a monthly key reversal. If we close tomorrow night either over 2004 or under 1963, then we'd be on. Right now we are most definitely looking at a monthly key reversal up here. To try and get a feel of what is happening, I took a look at the long-term monthly charts, and there was the answer to the situation. We have a secondary harder to reach target X in the 2140 area for the diamond bottom formed over 2019 to 2020. I go into this target and longer term patterns surrounding it in my annual video commentary and review of New York sugar published at the start of this year. Going back now to the immediate market, we're not too far away from target X now. Ice Europe, white sugar in London. Changeovers produce some strange events here. Since mid-September, this market has been dominated by the one action, the changeover gap that happened back then. I'm going to say a lot of things about what happened beforehand, but that changeover gap seen here on the continuous daily chart is really big. There has been a number of attempts since to try and fill it, but each time the market stretched higher, it ran short because of another changeover. Such a move was most recently seen in December last year. Since that gap lower in December, prices have fallen down to the lower time, currently at 536.70 of the late October to late November 2022 bullish shift pitchfork, where the action at the time created a pipe bottom over the first proper weekend of 2023 before moving higher. I've highlighted this bullish shift pitchfork in dark blue on my daily chart to aid in the conversation. Yet the move higher was stymied 3 weeks ago by a shooting star pattern, type 1 bearish, and then 2 weeks ago by a pipe top. Yet all that seemed to do was just slow the ascent as the lows kept getting higher and the market kept approaching the February 2017 high at 565 overhead and the rising middle time currently at 568.20, which is where we are now. So far, despite one breach, the bullish shift pitchfork has held up prices, if not spectacularly. Prices are now approaching the December base gap in the market above between 565 to 571. The middle time runs right through it, and I'm looking forward to seeing what will happen when the market meets both of those at the same time. We'll then have the December high at 579.60 and a November high of 568.40 and 581.40. Those are two highs actually at 568.40 and 581.40 to deal with. But the price beyond that will be the most interesting, as that's when we had the original September gap to work on. But the problem is we're running out of time, as you can imagine, into the new month. Meanwhile, below we have all the Fibonacci's in a close bundle between 547.90 and 546.30, with the March 2017 high nearby at 548.80 and the rising lower time slowly entering the frame. Sugar white premium spread. Well into the new year, and this chart continues to be very, very colourful. Many things are going on all at the same time. Okay, so I'd previously spoken about two big picture items here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my daily chart, with the market currently just above the lower time below, currently 87 3/4. Though this pitchfork has been breached in the past, it still continues to show the overall major bullish angle of attack. But for how long? Well, I am not so sure now. Next we have an ascending wedge pattern. I'll deal with that in a second, but next we have an ascending wedge pattern highlighted in bright red trend lines above the market. This was formed between mid-April to late November, currently at 157.5 to right off the top of my weekly chart. To me, it was and still is not the best looking of such wedge patterns, but it is also still there, still working, and it comes with all the possibilities such a pattern can invoke. The most recent activity has been the small reactionary move back up, started at the end of November last year, after an earlier huge counter-to-counter weekly key reversal down. Since then, prices have pulled up higher a bit, but seemingly peaked 3 weeks ago and have started to head lower. We are now approaching once again the lower time below the big 2019 to 2021 bullish Andrews pitchfork, as well as the nearby neckline of the February to September 2020 head and shoulders top. That's currently at 75 3/4 and is highlighted in purple on my daily chart. I suspected some 7 weeks ago this neckline might end up being important, hence the highlighting. In case you're interested, the secondary hard to reach target X1 for the expanding wedge pattern is way down in the 46 3/4 zone. Now this all circles my thoughts back to something I said 6 weeks ago, and I quote, "It's crossed my mind that perhaps, just perhaps, the action since the middle of November might be building up to be a possible bear flag or bearish half hesitation. It is early yet to really even think this, but I just wish to lodge this thought in your mind in case it turns out to be something." End of quote. Well, things have moved on since then, and it's turning out to be something. And the danger from such a pattern has grown once more for another week. I think it's time to indicate a potential target below for such a bear flag stroke bearish halfway hesitation type pattern. Therefore, target X1 is in the 72.5 zone, just below the purple neckline.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.